Welcome to This Explainer. Today, we're diving straight into the legal, financial machinery that ultra-wealthy executives use to minimize their tax liabilities. Now, this is a perfectly legal framework, and honestly, understanding it gives us a fascinating, completely objective look into the nuts and bolts of global tax law. In financial circles, this strategy was famously coined by tax law professor Ed McCaffrey as buy, borrow, die. I know, it sounds a little dramatic, right? But as we're going to see, it's actually a highly structured, surprisingly logical step-by-step process used to manage immense wealth. Okay, let's kick this off with a really fascinating paradox. You've probably seen the headlines over the years, and honestly, this isn't a new phenomenon at all. Going all the way back to Lee Iacocca at Chrysler in the late 70s, to Steve Jobs returning to Apple in the 90s, right up to today with founders like Mark Zuckerberg or Larry Ellison. These wildly successful executives often announce they're taking a base pay of practically nothing. So the question naturally arises, how on earth do some of the wealthiest individuals in the world afford incredibly lavish lifestyles? We're talking massive estates, private jets, super yachts, while officially taking only a token paycheck from the giant companies they run.
Well, that $1 salary isn't just a clever PR stunt to show solidarity with the workforce. And it's definitely not a sign of extreme frugality. It's a deliberate, highly calculated financial decision designed to bypass the traditional tax system entirely. By setting their official, taxable salary to a single dollar, they intentionally step completely out of the standard income tax framework that the rest of the working world operates within. Now, you might be wondering, why exactly $1? Why not just make it zero? Well, often, that single dollar is the bare minimum legal requirement to maintain official employment status. It keeps them eligible for company health insurance or lets them participate in specific legal corporate agreements. It essentially keeps them on the books, but without generating any taxable income.
So here is our roadmap for today. First, the $1 salary. Second, borrowing against wealth. Third, the low interest advantage. Fourth, overrolling the debt. And finally, a tale of two taxpayers.
Section 1. The $1 salary. To really grasp the strategy, we have to look at why a standard paycheck, the primary source of wealth for most of us, is practically the enemy of the ultra-wealthy when it comes to tax efficiency. Imagine a highly successful tech founder decides they want to buy a new property, so they pay themselves a standard salary or take a cash bonus of, say, $100 million. Before that money even hits their bank account, state and federal governments are going to step in. Depending on where they live, top-tier income tax brackets can easily hit 40% or even higher. That means $40 million of their wealth is just instantly gone to taxes. So, to a billionaire, traditional earned income is literally the most mathematically inefficient way to generate spending power.
Section 2. Borrowing against wealth.
So if these founders aren't taking a salary and they want to completely dodge that 40% hit, they have to pivot. They still need cash to live and buy things, but they can't earn it as income. And they definitely don't want to sell their company shares, because selling triggers a heavy capital gains tax. The magic solution? Leverage. Think of it like a home equity line of credit, but on a cosmic scale. If your house goes up in value and you take out a loan against it to, say, remodel your kitchen, the IRS doesn't tax that loan. The ultra-wealthy just apply this exact same, everyday financial logic to billions of dollars of company stock. Under tax laws globally, a loan is legally defined as a liability. You have to pay it back. It is not an asset generation event, so it is completely invisible to income tax.
Let's weave these mechanics into a concrete example to see this playbook in action. Let's say our founder wants to buy a $50 million super yacht. Rather than selling stock to get the cash and losing millions in capital gains taxes, they just execute these 3 steps. Step 1, they hold on to their incredibly valuable company stock. Step 2, they go to a major investment bank and use a portion of that stock as collateral to secure a massive loan. And step 3, the bank wires them $50 million in cash. They buy the yacht completely tax-free. By using debt, they're allowed to defer taxes indefinitely while keeping full ownership of assets that are usually still growing in value.
Section 3. The low interest advantage.
Now you're probably thinking, wait a minute, loans naturally carry interest, and borrowing $50 million sounds incredibly expensive. And for the average person, it absolutely is. A typical citizen might fight for weeks just to secure a 6 or 7% rate on a mortgage. But high net worth individuals are operating in a totally different reality. Because they possess billions of dollars in liquid, highly sought after collateral, banks actually aggressively compete to offer them loans. There is practically zero risk for the institution. As a result, these billionaires can secure interest rates that are microscopic, sometimes just 1 or 2%. So the cost of borrowing this money is almost always lower than the rate of inflation, and crucially, it's lower than the rate at which their underlying stock is appreciating. Through this mechanism, they gain access to an enormous pool of incredibly cheap, tax-free cash. And what do they do with it? They use it to fund everyday luxuries. They acquire expansive real estate portfolios. They aggressively invest in new, lucrative business ventures. Now, to be fair, this strategy does carry a tiny sliver of structural risk. If the stock market crashes and the value of their company shares plummet, the bank might issue a margin call, forcing them to produce more collateral or sell stock at a loss to cover the loan. But barring a catastrophic market collapse, they are effectively living a cash-rich life funded entirely by debt, secured by assets they never even sold.
Section 4. Overrolling the debt.
Inevitably, you have to ask the obvious question here. What happens when the bank comes knocking and that massive loan finally comes due? Don't they have to sell their stock to pay it back, which would finally trigger that massive tax bill? The answer is no. They use a process called overrolling or refinancing. Over the years they've held the first loan, their company's stock has likely grown significantly in value. So they just secure a brand new, larger loan against those newly appreciated shares. They use the new loan to pay off the old debt entirely, and they pocket the difference as fresh, tax-free spending cash. This cycle of borrowing and overrolling continues endlessly until the end of their life. And this brings us to the final piece of the puzzle, the die in the buy, borrow, die strategy. When the individual passes away, their estate utilizes a specific tax provision known as the step-up in basis. This provision effectively resets the taxable value of their inherited assets to the current market price. It wipes out decades of massive deferred capital gains taxes in an instant. The heirs inherit the stock at its new, higher value, sell a small portion tax-free to pay off the outstanding bank loans, and keep the vast majority of the wealth entirely intact. It's really quite incredible.
Section 5. A tale of two taxpayers. Stepping back to look at the macro view, this side-by-side comparison perfectly illustrates how two very different financial systems operate under the exact same law. The average earner is basically playing a financial game of subtraction. They earn a salary, taxes are immediately subtracted at the source, and they can only use the remaining smaller pool of money to pay their bills, buy goods, or slowly save. Conversely, the ultra-wealthy utilizing the buy, borrow, die framework are playing a game of addition and infinite deferral. They hold on to appreciating assets, they add cheap debt completely tax-free to fund their lives, and they push their tax obligations infinitely into the future until the rules of inheritance wipe them out completely. It's just two radically different mechanical approaches to living, spending, and building wealth.
So as we wrap up this explainer, it leaves us with an incredibly important, impartial question. How does the very mechanical design of the tax system, the simple fact that loans are not income and that capital gains are only taxed upon a sale, truly define the realities of financial growth in our society? Remember, this isn't about rule breaking. It is entirely about rule using as the laws are written today. Understanding these structural mechanics is absolutely essential to understanding modern wealth. Thank you so much for joining me today, and I really hope this provided a clear, structured view into the fascinating machinery of high-level finance.